Right, let's move on now to a couple of corporate conversations this morning. The CV cycle seems to be showing signs of a bit of a slowdown. That's what trade channel checks are indicating. Now, this includes sales of heavy commercial vehicles. So LCV or light commercial vehicles as well as used CV trends are still a bit steady. Ramesh Iyer, Vice Chairman and Managing Director of Mahindra & Mahindra Financial Services, is now joining in with his analysis and his take on the situation. Mr. Iyer, good morning. Always a pleasure having you on the show. What is your assessment? What is happening on ground? Is there really a slowdown building up?
So yes, what we have seen is definitely the first-time users are a little less, and the fleet operators are the ones who are actually adding capacity. So definitely we are seeing a little slowdown in different pockets, but it's not significant to really fear about. I think what I believe is even the commercial operators who were depending on maybe banks, etc., for their own borrowing and are not possibly able to raise as much money that they may wanted to, could be one of the reasons. But I think more than that, it could be for reasons of, the freight rates have to be readjusted to the new cost that is being incurred, and that would have possibly also caused some slowdown. But I would think that should get corrected. But yes, if you look at the last couple of months, there has been a little lower inquiry levels for commercial vehicle.
Okay, so there is a fall in CV sales, but it's not significant to worry about. That's good to hear. What about the growth in tractor sales? That has been very strong. What has been the uptrend in terms of tractor financing, and what's the expectation as we head into the new year?
So we are largest tractor financier, and we have also got into financing of second-hand tractor, and therefore our growth has also been very, very robust. And clearly we have seen the tractor growth is at the back of not just the farm purchases, but also haulage purchases by contractors. And definitely there has been replacements of contractors who have been using the tractors for haulage application. So I think all the three front cash flows have been good, which has resulted into growth story, and we have definitely been benefited by that.
Okay, so tractors seem to be doing well. A word on the liquidity conditions also, Mr. Iyer. Now, I mean, a lot of money is being pumped in by the Reserve Bank. Has that helped in relieving some of this elevated stress in the NBFC sector, or are portfolios still feeling this liquidity crunch?
I think if you look at us in particular, I may not be able to overall comment for all NBFCs, but clearly we have had a very aggressive growth in the past, because rural is still registering decent growth, and we are a very multi-product company. So if an NBFC is a very single product company, possibly they may have little pressure if the product isn't growing. But on account of non-availability of liquidity, I'm not too sure is there any major impact on NBFCs, at least the auto financing NBFC, the vehicle tractor, commercial vehicle, pre-owned vehicle financing company, and my answer would be no.
So what is your borrowing mix right now, and are banks giving sufficient credit to NBFCs?
So we've engaged with almost all our bankers with whom we have been borrowing in the past, and we have not had no as an answer from anyone. So we have either used our available limits, or we have even received certain new limits from other sources. In fact, we also received some funds from NABARD. So I think generally we've been able to get funds from all sources that we were engaged in the past, and therefore the mix of funds may not have substantially changed. And I've always said this, we have had one of the best ALM match all the last 20 years. If you look at our book, we always had positive match in every bucket. So I would think overall things have definitely changed, and it was stressful maybe a couple of months, but we've not had no as an answer from any lenders.
Okay, all right, that's good to know. Of course, I mean, you're one of the sector leaders, so perhaps things work differently. Anyhow, now coming to a separate point, fuel costs have of course gone down with this plunge in oil prices. Also, GSEC rates have cooled off. How do you see this benefiting demand over the near term?
So as far as the fuel cost reduction is concerned, most of the vehicles that we are financing are put to commercial use, whether as a tourist or whether it is commercial goods carrier or, passenger carrier. And therefore, when the operating cost comes down due to fuel is one of their important operating cost, and as that comes down, I think they would be left with better surplus, and we would imagine that would be used to definitely even repay installments on time as they have been doing in the past. In as far as overall the GSEC coming down, etc., should benefit on the long run going forward on the borrowing cost front as well. There was always this looming fear of will the borrowing cost further go up. At least that seems to be somewhere settling down to believe that the cost may not further go up.
So have you seen your borrowing costs or the cost of funds movement go up over the last, say, couple of months? What has it been? And has the net interest margin remained steady for you, or is there pressure there?
The fresh borrowing that we have done in the last 3-4 months has costed us 50-60 basis point more, maybe even some cases 70 basis point more. But clearly our net interest margin is an outcome of even the product mix that we use for our lending. And since the pre-owned vehicle and tractor business have registered little aggressive growth for us, our net interest margins have almost remained stable. That has not impacted us. But it's important to understand that when the borrowing cost has gone up by 60-70 basis point, we've been able to pass on at least 25 to 40 basis point to the consumers. And we have also tried to share some with dealers and OEMs in some cases. So we've tried to protect margins by a multiple mix.
Okay, and finally, sir, just a view at the industry level. What has been the debt servicing capacity? Others were, constrained, but of course your position is much better, as you just mentioned. Have you then managed to gain market share because others are still setting their house in order?
So clearly, I don't think we have heard of any default by any NBFC during this period. So therefore, it's very clear that everyone has discharged their liability on time. In as far as gaining of market share is concerned, definitely we have gained market share, and we operate largely in rural, and we don't see competitive intensity very, very high there. And we have gained market share in fact, I would think in every product, whether it's in the Mahindra UV segment or in the tractor segment, or for matter the car segment. I think we've gained market share in all segment in rural, and that's helped us in our growth story.
Okay, Mr. Iyer, thanks so much for joining us. And it's good to hear that the credit from NBFCs has picked up once again. However, there's some disappointment because there's a slowdown in the commercial vehicle space, although, as he says, it's not as significant to worry about right now. But let's move on. Last evening, the former Prime Minister